Hmm. Hello and welcome everyone. Our today topic is be able to account for capital gain tax. This is Unit 5 of Personal Taxation. In today's lecture, today's lecture is on capital gain tax and important aspect of personal taxation. Today we will discuss what capital gain tax is, how it works, and why it's significant for individuals. Capital gain tax is an essential aspect of personal taxation, impacting individuals who earn profit from the sale of certain assets. So, by understanding how it works and ensuring compliance with relevant tax laws, individuals can effectively manage their tax liabilities and financial obligations. Right. My name is Yasir Gulfraz, and I'm your tutor for today's session. So, if there is any issue, please do let me know. If anyone is there, I hope you can see my screen or can you hear my voice? Here is self-assessment. One is not confident at all, and it's going up to 10, as confident as possible. You can measure your knowledge. You can rate your knowledge. Indicative contents obviously are today's main area of discussion is capital gain tax. So account for capital gain tax, chargeable gains and allowable assets, uh, chargeable gains and allowable persons, connected persons, chattels and wasting chattel rules, calculation of chargeable gains and allowable losses, calculation of gains and losses arising from the disposal of shares, uh, calculation of capital gain tax, personal allowances, rates, and bands. Explain the difference between chargeable and exempt assets. So here we are going to explore the concept of chargeable and exempt assets in the realm of capital gain tax. Understanding the difference between these two types of assets is important for managing your tax obligations effectively. So let's start with chargeable assets. These are assets that are subject to capital gain tax when they are disposed of by a person who is liable to pay capital gain tax. A chargeable disposal occurs when you sell gifts, chargeable or otherwise dispose of chargeable assets. This includes not only full disposal but also part disposal. So where only a portion of the assets is transferred. On the other hand, exempt assets are those that are not subject to capital. Uh, those are not subject to capital. Uh, 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 Rechargeable disposal for exempt disposal includes certain type of transactions that are not considered chargeable disposal. For example, if you donate an asset to charity, the disposal is exempt from capital gains tax. So similarly, assets transferred upon death are also exempt from capital gain taxes as they are inherited by the beneficiary at their market value at the time of their deceased death. Just bear in your mind that while chargeable disposal trigger capital gain tax liabilities, exempt disposals do not. This means that when you dispose of exempt assets, you don't need to worry about calculating and paying capital gain tax on any gains made from the transactions. Chargeable assets are subject to capital gain tax when disposed of while exempt assets are not. So understanding the difference between these two types of assets can help you navigate the complexities of capital gain tax and ensure compliance with tax regulations. uh, Rates of capital gain tax. Right here, specifically, we are discussing year 2019 and 2019 and 20. This is basically for we use this year as an example. Okay, so basic concept is same throughout. 29 till 24. So we are going to discuss the rates of capital gain tax, which determine how much tax you will need to pay when you make a profit from selling certain assets. Firstly, let's understand that there are different rates depending on the type of assets you are selling. For most assets, such as stocks, bonds, and non-residential property, the rates are 10% and 20%. 10% for basic rates taxpayers and 20% for higher rate taxpayers. So when it comes to selling residential property, the rates are bit higher at 18% for basic rate taxpayer and 28% for higher rate taxpayers. If your total taxable income, including the gains from selling the assets, falls within the basic rate tax bands, you will be taxed the lower rate of either 10% or 18%. Depending on the type of assets. So this basic rate tax band is currently set at 37,500 for the tax year 2019 and 20. So if your total taxable income pushes you into the higher rate tax band, any gains from selling assets will be taxed at the higher rate of either 20% or 28%. So this applies to any portion of the gains that exceeds the basic rates rate tax band's threshold. So it is important for us to note that the basic rate tax band can be extended if you make certain contributions, such as personal pension contributions or donations to charity through the gift aid schemes. So this means you may be able to reduce your tax liability by utilizing these allowances. Here is various aspects of taxation, including income tax, capital gain tax, and other important concepts related to taxation systems. So we will discuss further. So basically, here, six, if you see here, main taxes, various aspects of taxations, including income tax, capital gain tax, national insurance contribution, and inheritance tax. So as you know that income tax, this is imposed by the government on the income earned by individuals and businesses. So capital gain tax, this tax is levied on the profit made from selling certain assets like stock, bonds, or property. So the amount of tax you pay depends on the profit you have made and the type of assets you have sold. Then next one is national insurance contributions. National insurance contributions are payment made by individuals and employers to fund state benefits, so such as the state pensions and healthcare. So these contributions are separate from income tax but are deducted from your earning in a similar way. Any questions so far? If there is anyone, can you see my screen or can you hear me properly? Okay. So the last one is one last one is inheritance tax. We discussed previously as well. Inheritance tax is a tax imposed on the estate of a deceased person before it is passed on to their hires. So the tax rates and thresholds vary depending on the value of the estate and the relationship between the deceased and the beneficiaries. Here we are is talking about exemptions, key terms related to capital gain tax and exemptions. So exempt persons, disposals, and assets. So there are individuals or entities that are not liable to pay capital gain tax on certain transactions. For example, charities are often exempt from capital gain tax when receiving gifts or donations. So, chargeable disposals, the transactions that trigger a capital gain tax liability, they can include selling an assets, giving it away as a gift, or exchanging it or something else of value. So, when we talk about exempt assets, these are assets that are not subject to capital gain tax. When sold or disposed of, they include things like personal belonging, your main home in certain circumstances, and government bonds. On the other hand, chargeable gains are the profit made from the chargeable disposal. They are subject to capital gains tax after deducting any allowable expenses or losses. Capital losses occur when the sale of an asset result in a loss rather than a profit. So these losses can be used to offset capital gain made in the same tax year or carried towards or offset gains in future years. So every year, every tax year, individuals are entitled to an annual exempt amount. So this is the amount of capital gains that can be made before any tax is due. So it is like tax-free allowances for capital gains. Here we are discussing the capital gain and the difference category of persons and assets involved. So first we will discuss the chargeable persons. These are individuals or entities that are subject to capital gain taxes when they sell or dispose of certain assets. For example, individuals are liable to pay capital gain taxes on gain made from selling investment or property. Similarly, companies pay corporation tax on any gains they make. On the other hand, we have exempt persons. Here you can see exempt person as we discussed about charities. These are individuals or entities that are not liable to pay capital gain tax or certain transactions. One common example in charities is charities. When charities receive gifts or donation, they are typically exempt from capital gain tax on these transactions. Now we will talk about chargeable assets. These are capital assets that are subject to capital gain tax when sold or disposed of. Essentially, any assets that is not exempt falls into the category. This can include things like property, stock and shares, and valuable personal belongings. Conversely, exempt assets are not subject to capital gain tax when sold or disposed of. So these includes your main home, cash held in bank account, motor cars, and certain other assets like bravery medals if not purchased, gambling, winning, and or damage received. So understanding uh, These distinctions between chargeable and exempt person and asset is important for navigating capital gain tax obligations. Any questions? Any issues? Now we are going to talk about chattels, which are tangible, movable properties. Chattels comes in different types, including wasting chattels and non-wasting chattels. First, we'll talk about wasting chattels. These are exempt from capital gain tax if their expected useful life is 50 years or less. Exemptions of wasting chattel, including terms like caravans, boats, dishwashers, TVs, and even race horses. Any animals recounted in the category are considered wasting chattels. When we talk about non-wasting chattels, these are exempt from capital gain tax if they are bought and sold for £6,000 or less, uh, uh, and have an expected useful life of more than 50 years. So, example of non-wasting chattels including antiques, jewelries, and paintings. Any questions so far, if anyone is there? So, pro forma capital gain tax liability consumptions 2019 and 2000. Here we will break down how to calculate your capital gain tax liability for the tax years 2019 and 20. First, you need to determine your chargeable gains for the year. This is the total amount of gains you have made from selling or disposing of assets during the tax year. Next, subtract any capital losses you have incurring during the same tax year. This gives you your net chargeable gains. Then subtract the annual exempt amount from your net chargeable gains. The annual exempt amount, or AE, is the amount of gains you can make in the tax year before you have to pay any capital gain taxes. After subtracted the AEA, if you have any capital losses brought forward from previous tax year, subtract those from the remaining amount. This gives you your taxable gains. Now you need to calculate your capital gains tax you owe. If your taxable gains fall within the basic rate band, you will pay tax at a rate of 10%. If your taxable gains exceeds the basic rates band, the amount above the BRB will be taxed at a higher rate of 20%. Also remember your capital gain tax liability for the tax year 2019-20 is due on 31st January 2021. So make sure is plan ahead and set aside the necessary funds to pay your tax bill on time. Understanding how to compute your capital gain tax liability is important for managing your finances and ensuring compliance with tax regulations. If you are unsure about any aspect of your tax calculation, it is always a good idea to seek advice from a tax professional or financial advisors to avoid any potential issues or penalties. Explain the difference between chargeable and exempt persons. So chargeable, we are going to discuss the capital gain tax. Capital gain tax is that charge when you make a profit from selling or disposing of certain assets. So let's break down some key concepts related to capital gain taxes. So chargeable gains. So chargeable gain, this is the profit you make from selling of disposal of an assets. that's subject to capital gain tax. It is difference between the sale price and the purchase price of the assets. So I'll go through one by one. So chargeable persons, individuals, and companies are both subject to CGT, capital gain tax. Individuals pay CGT on their personal gains, while companies pay corporation tax on their gains. Chargeable assets, all assets unless specifically exempt. So all assets are considered chargeable unless they are specifically exempt. This include things like property, investment, and valuable personal belonging. Chargeable disposals, any sale, gifts, or disposal of an assets can trigger capital gain tax. This includes selling a property, giving away shares as a gift, or even the loss or destruction of an assets. Now we will talk about exempt assets. Certain assets are exempt from capital gain tax, meaning you won't have to pay tax on any gains. Any gains you make from them. Examples of exempt assets include your main home, principal, private residence, motor cars, and shares held in an individual saving accounts. Next is exempt disposals. Similarly, certain disposal are exempt from capital gain tax, meaning they won't trigger any tax liability. These including transfers of assets upon death, gifts to charity, and compensations received from personal injury. Any questions so far, if anyone is there? Okay, now there is an example. Mr. Ahmed has chargeable gains. The selling quoted from 33,600 pound for the tax years. Calculates Ahmed gains tax liability uh, for the tax year 2019 and state the due date for payment. So, assuming Ahmed has taxable income of 4,370 pound, assuming Ahmed has taxable income of 27,855 pound. So, CGT liability. So Ahmed has made some profit from selling quoted share, and we need to determine how much capital gain tax he owes based on his taxable income. So assuming Ahmed has taxable income of 403,070, first we need to calculate Ahmed's taxable gain from selling the shares. So his chargeable gain from selling the shares are 33,600 pounds. Okay, here you can see, and the annual exempt amount of the tax year is 12,000 pounds. So his taxable gains are 33,000 deduction minus 12,000. So taxable gain is 21,600 pounds. So since all Oppenheimer taxable gains fall within his unused basic rates band of 33,130 pounds, 37,500 minus 4,307 50. So he will taxed at the basic rate of 10%. Therefore, his capital gain tax liability is 21,600 pound multiplied by 10%. Is equal to 2,160 pounds. So Ahmed must pay his capital gain tax liability by 31st January 2020. Uh, then B is tax liability, assuming Ahmed has taxable income of 27,855 pound. Here we need to calculate Ahmed's unused basic rate band. First, it is 37,500 pound minus 27,850 pound is equal to 9,645 pounds. So his taxable gains remain the same at 21,600 pounds since his taxable gains exceed the unused basic rate band. So part of it will be taxed in the basic rate of 10% and the rest of the higher rate of 20%. So understanding how to calculate capital gain tax liability is essential for individuals like Ahmed who have made profits from selling assets. By ensuring compliance with tax laws and meeting payments deadlines. Individuals can avoid penalties and manage their tax obligations effectively. Uh, Now we are going to discuss part disposal and assets damages. So damages of asset when it comes to the calculating capital gain taxes, part disposals when only a part of an asset is sold, we need to determine the cost of the part that is sold. To do this, we use a simple formula: cost of part of assets disposed of, uh, uh, allowable cost of whole assets multiplied by A divided by A plus B. So here, so represent the proceeds of the part of uh, sold, and B represent the market value of the remaining parts asset loss of destroyed. If an asset is lost or destroyed, the proceeds will be any insurance or damages received. If there is no insurance, the proceeds will be nil, resulting in a loss. However, if the assets is replaced within 12 months, the taxpayers can claim that no gain or loss will arise. Assets damage. If an asset is damaged and there is no insurance or damage received, there is no disposal. If insurance is received, there is a part disposal, and we use the formula mentioned earlier. Uh, Here, A represent the compensation received, and B represent the market value of the assets in its damaged conditions. Okay, so but if insurance is received and used to restore the assets, the taxpayer can claim to deduct the compensations from the cost of the assets rather than treating it as a part disposal. Understanding these rules is important for accurately calculating capital gain tax liabilities in scenarios involving part disposals, losses and damages of assets. By applying the appropriate formula and understanding the implications of insurance and damages, taxpayers can ensure compliance with tax regulations and minimizing their tax liabilities effectively. Any questions so far? Okay, chattels. If anyone is there, can you explain what chattel is? Okay, chattels, simply put, are tangible, movable properties. Think of items like paintings, dogs, or antiques tables. So these are all exempts of chattels. Within the category of chattels, we have two main types: wasting chattels and non-wasting chattels. Wasting chattels are those with an expected life of 50 years or less. Classic example is dog. For capital gain tax purposes, wasting chattels are exempt assets, meaning any gains or losses from their disposal are not subject to capital gain tax. Now, when we talk about non-wasting chattels, on the other hand, have an expected life of more than 50 years. Examples including antique tables and paintings. Special rules apply to non-wasting chattels, especially when it comes to calculating gains and losses. If the sales proceeds or cost of the non-wasting chattel is £6,000 or less, then the disposal is exempt from capital gain tax. So this means any gains or losses from the disposal are not subject to tax. So here also sales proceeds exceeded £6,000, then a normal gain or loss comes. Computation applies. However, if the sale proceed exceeds 6,000, but the cost is £6,000 or less, then the gain is restricted. In this case, the gain is calculated as third, gross proceeds minus the difference between the gross proceeds and £6,000. So it is essential to understand these rules, as a question on chattels often appears in assessments. Remember, wasting chattels are exempt, while non-wasting chattels have specific rules regarding gain and losses depending on their sales proceeds and costs. Any questions so far? Okay, so connected persons are individuals or entities who are closely related to each others, either through family ties or other relationship. When it comes to capital gain tax, transactions between connected persons are subject to specific rules to prevent tax avoidance. Some key points about connected persons and their implications of capital gain tax is market value. Uh, when disposing of assets to a connected person, the market value of the asset is used instead of the actual proceeds. This ensures that transactions between connected persons are treated fairly for tax purposes. Uh, Offsetting losses. Uh, if a loss occurs and on a disposal to a connected person, it can only be offset against gains arising from disposal of the same connected person. So they prevent individuals from using transactions with connected persons to artificially reduce their tax liability. Connected persons include various family members and their spouses, such as parents, grandparents, sibling, children, grandchildren, and civil partners. Additionally, relatives of civil partners are also considered connected persons. By applying their rules, HM Revenue and Customs aims to ensure that transactions between connected persons are taxed appropriately and that individuals do not exploit their relationships to avoid paying their fair share of capital gain tax. So, understanding these rules is important for taxpayers to comply with capital gain tax regulations and avoid any unintended tax consequences. Any questions so far, if anyone there? Shares. When we talk about shares, individuals sell shares in a company that were acquired through multiple purchases. It becomes necessary to determine which specific shares have been disposed of. There is where matching rules comes into play. So, how the matching rules of shares typically work? Uh, uh, Same day acquisitions, shares acquired on the same day as the disposal or matched first. This means that if you purchased shares of the same type of the same day as the disposal, they are considered to be the shares disposed of. Acquisition within 30 days. If no same day acquisition exists, shares acquired within 30 days after the disposal are matched next. This ensures that recent acquisitions closely related to the disposal are considered. Uh, Share pool. If shares remain unmatched after considering same day acquisitions and acquisition within 30 days, shares from a pool of similar shares are matched. So these pools consist of shares acquired earlier, and the specific shares disposed of are determined based on the average cost of the pools. So once the matching process is complete, the cost of the matched share is used in the standard capital gain tax computation. This includes determining the allowable cost of the shares and calculating the capital gains or losses based on the disposal proceeds. Uh, Share pool bonus issues. when a company issues bonus shares to its existing shareholders, it distributes additional shares for free based on the number of shares already owned by own. For example, in a one-fourth bonus issue, a shareholders with 400 shares would receive an additional 100 shares for free. From a capital gain tax perspective, bonus shares are not considered as a separate holding of shares. Instead, they are treated as a part of the existing share pools. Share pool share acquired before the bonus issue, along with the bonus shares received are pooled together. The bonus shares are added to the share pools, but their cost is considered as nil. So, treatment of bonus shares: the bonus shares are not assigned a separate cost. Instead, they are treated as if they were acquired on the same day as the original share to which they related. So this means that the cost of the original share is used for calculating gains or losses when the bonuses shares are disposed of. Calculation of gains or losses when bonuses shares are disposed of. The number of shares sold is deducted from the total number of shares in the pool, and the cost to date of the original share is used to determine the capital gain tax or losses. Any questions so far? Okay, right issues, principal, private residence reliefs. So, right issue involves distributing shares to existing shareholders at a price lower than the market value. For example, in a three right issue at £10 per share, a shareholder with 300 share would require 100 shares at a cost of £1,000. So, right shares are treated for capital gain tax purposes. So, right shares treatment similar to bonus shares. Right shares are not considered as a separate holding of shares. Instead, they are treated as they were acquired on the same day as the original shares to which they relates. So, uh, inclusion in share pool: right shares are included in the share pools in the same way as a normal purchase. This means that the cost of acquiring right share is added to the total cost of shares in the pool. Uh, Principal private residence relief is a tax relief available to individuals who occupy their main residence. The relief aims to exempt or reduce the capital gain tax liability arising from the sale of the main residence. So, uh, understanding the treatment of right shares and the application of PPR or private principal private residence relief is essential for taxpayer to accuracy assess their capital gain tax liabilities and take advantage of available tax relief. Any questions so far? Any issues? Okay, so here in our further reading, exempt proportion of capital gain tax period of occupation or periods of actual occupation and deemed occupations. So here is the formula for exempt, proportion of capital gain. The exempt proportion of the capital gain is calculated by divided the period of occupations, including deemed occupation, by the total period of ownerships. So there are some key points like PPR calculations. Principal private residence relief is calculated before deducted capital losses. This means that the relief is applied to the total gain from the sale of the property before any losses are taken into account. Then period of occupations include both actual occupations and deemed occupations. Actual occupation refers to the time when the property was physically inhabited by the owner. So deemed occupations include certain specified periods, even if the owner was not physically present in the property. So deemed occupations last 18 months, the property is deemed to be occupied by the owner for the last 18 months of ownership, even if they were not living there during that time. Extended periods, when we talk about extended period, in some cases, such as working overseas or within the UK, the deemed occupations period can be extended beyond 18 months up to certain limits, preceded and followed by actual occupations. Any period of deemed occupations must be followed by a period of actual occupation of to qualify for PPR reliefs. Any questions so far? Right. Calculate capital gain tax payable by an individual from given data. So here we discuss how to calculate the capital gains taxable, payable by an individual using the given data for Douglas in the tax year 2019 and 20. So Douglas has two chargeable gains here, June. On the 15th, he said an antique ways resulting in a chargeable gain of 18,800 pound, and on August 2019 he sold a residential property and is resulted in a chargeable gain 39,500 pounds. So Douglas capital gain tax liability is, so calculation is here, right? So capital gain tax calculations, chargeable gain 39,500 pound, annual exempt amount 12,000, taxable gains 27,500 pound. Obviously 39,500 minus 12,000, so 20,000. Seven other gains 18,800 pounds. Capital so capital gains tax 18% on 27,500, then 10,000, and at 10%, 8,800 pound at 20%. So total is 7,000. Total liability, tax liability 7,710 pound. So the annually the CGT liability would be calculated separately for each gains. For the antique values gain 1880, which is 10% on 18,800 pound, and then plus 33,300 pound, 18% on 18,700 pound, and 28% on above, a higher limit, which is on 8,800 pound, and this is 2,464 pound. So total is 7,710 pound. So here, here is discussing the order of offsetting losses when calculating capital gain tax. Annual exempt amount, the annual exempt amount is the amount of capital gain that an individuals can make in a tax year before they have to pay capital gain tax. So it should be deducted after the set of current year capital losses, but before setting of any brought forward capital losses. Brought forward capital losses, brought forward capital losses, or losses from previous tax years that can be used to offset against current year capital gains. So these losses are deducted after deducting the annual exempt amount, but before calculating the taxable gains. Standardized terms, chargeable gains refers to the gains before deducting the annual exempt amount, and any brought forward capital losses, taxable gains refer to the gains after deducting the annual exempt amount and any brought forward capital losses. When calculated capital gain tax, the annual exempt amount is deducted after setting off current year capital losses, but before setting off any brought forward capital losses. So this ensures consistency and clarity in the calculation process. So for tax year 19, NIM has chargeable gain of 18,000 pound and capital losses 15,000. So NIM's taxable gains for 2019 and 19s are. So here is the examples. So calculation is chargeable gains 18,000 pound, capital losses 15,500 pound. Tax gains is 18,000 pound minus 15,800 pound is 102,000 pounds. Sorry, here. So 18,000 minus losses 15,800 pound and is equal to taxable gains is 2,200 pounds. So annual exempt amount is 2,200 pound. Taxable gains is 0. So next is uh, chargeable gains 18,000 pound, annual exempt amount 12,000, capital losses brought forward means from previous year 6,000 pounds. So the annual exempt amount is deducted before considering the brought forward capital losses. Taxable gains is equal to 6,000 pound. Sorry. So after deducting the annual exempt amount, only 6,000 pound of the brought forward capital losses can be offset. So here, basically, outcome is next taxable gains for the tax years 2019, 20 or 6,000 pounds. NIM still has capital losses carried forward amounting to 9,800 pound, which can be used to offset against future chargeable gains. So this demonstrates how capital gains and losses are calculated and how the annual exempt amount and brought forward losses affect the final taxable gains for the tax years. Yeah, that's it for today. Here, for further reading, you can visit accaglobal.com for further reading about capital gain tax, or you can visit your learning management system or Moodle. There will be a few books and related material for your reading as well. That's it, guys, for today. Thank you very much, and I'll see you next Saturday at 11:30 for our next session. Thank you very much for today and have a good weekend. If there is any question, concerns, issues, you can drop me an email at yasir@ukversity.co.uk. Thanks and bye for now.